Thanks for tuning into Talking Point. I'm your host Neeraj Shah, and it's an important start to the week, considering that it's the week wherein we have two key rate decisions: the BOJ and the Fed, the big one, really coming out on Wednesday. And as much as the decision would be important, the outlook maybe even more so. And not only that, over the weekend, US President Joe Biden spoke about how US will come to Taiwan's rescue in the event of a conflict. So the geopolitical stress is not over. We still have a lot of other variables. Glad to have in Manishi Raychaudhuri. He needs an introduction, but he heads the Asia Pacific research at BNP Paribas and he joins us right now on the show to talk about his thoughts on all of this. Manishi, great having you. Thanks for joining in.
Thank you. It's my pleasure, Teddy.
Yeah. So, Manishi, a lot of variables. Let's kind of dissect them one by one. Let's start with the big one, the Fed. And depending on what the Fed does and says, what's the likely implication scenarios?
After the Jackson Hole meeting and the most recent inflation numbers, it seems that this elevated rate hike expectations are going to last for a while. It now seems that the Fed is in line for another 75 basis points hike in September, followed by possibly a series of 50 or 25 basis points, taking the terminal rate to somewhere close to 4%. Now, this is a wildly shifting narrative. In fact, if we were to think about this terminal rate 6 months ago, it would have been nowhere close to 4%. Add on top of that the Fed's QT, which is actually accelerating to $95 billion in September and likely to remain there for the foreseeable time horizon. It means that liquidity is being sucked out from the global asset markets, which would have an outsized implication for flows into Asia. We've already seen that in the first 9 months out of Asia, about 64 to $65 billion have been taken out. And it looks like it's likely to stay that way for the foreseeable time horizon. So, the implication of Fed and possibly other developed market central banks' action is clearly not positive for Asian asset markets. We have already seen that, and we have to brace for some more time, to kind of take this into account.
Hmm. Yeah, the recent flows also seem to suggest that, I mean, save for maybe India, I don't know
Right.
if Taiwan kind of featured last week, but otherwise, save for India and a very few other OSs, the outflows continue. Now, what happens in the event of a combination of QT plus maybe a hawkish Fed and plus maybe geopolitics continue to rule? Do you reckon that these could get exacerbated, or at some point of time there will be some bit of realization that Asian valuations have certainly fallen? Not India, but Asian valuations have certainly fallen.
Right. You see, the problem with Asian valuations, and you highlighted the geopolitical risk that is an added variable now. The Asian valuations are being dragged down predominantly by North Asia. If I look at China or Korea, they're trading at record low valuations now. And understandably, because these markets in North Asia, like Korea and Taiwan, they are globally linked. There's a concern about recession in the European region or in the United States. So obviously, corporate earnings are being dragged down in those markets. China has a problem of its own, which is more domestic in nature, pertaining to the zero COVID strategy and the regulatory risks across different sectors. So a combination of this has actually dragged down the Asian average, while the ASEAN markets and India are faring relatively better. We have also seen flows actually gravitating towards those markets, particularly if you look at over the past 3 months, say since July, there is this sell North Asia buy India trade which has been going on amongst FIIs. It might last for a while. The only concern for India is relative valuations, which is a combination of India staying where it is at an elevated valuation level, while the rest of Asia, particularly North Asia, being dragged down. So, for now, we think that this flows gravitating to Asia and the FIIs targeting an overweight stance on India might continue. The only thing we have to watch for is a potential outperformance of North Asia, which may not happen right now because there's a this narrative of recession in the developed markets has to vanish. But we have to watch very carefully after the policy meetings in China in mid-October, because that's when moving ahead of the zero COVID stance and articulating strong economy boosting measures could actually come through.
Interesting. So, Manishi, what could drag India down? I'm trying to understand. Could it be higher crude prices? And would love to understand your view there that in a recessionary scenario in the West, can crude prices move higher because of supply constraints and a burn China or no? So that is part one. But so the part one is okay, let's start with your view on crude and then couple that up with what could move India lower. Could it be higher crude prices or could it be other variables combined?
Right. You see, if you look at India, the domestic side, as far as domestic economic growth or even stability of corporate earnings growth, these variables are doing fine. I mean, we have, of course, seen some of the externally linked sectors being dragged down in terms of corporate earnings, like IT services, where there's a concern about margins being hit because of the manpower shortage, etc. But barring those sectors, corporate earnings have been relatively stable, which is not the case in much of rest of Asia. The concern for India was always the external sector, which is the high trade deficit and therefore the consequent pressure on the currency. Now, over last maybe a month or so, as a consequence of the decline in fuel prices, which is in turn a reaction to the stagflation or recession narrative, the pressure on the currency has also been alleviated. So that is why I think that actually holds the key to India's outperformance. While the domestic side was always relatively stable, the external sector was a concern, and that concern has been partly alleviated over the past 1 to 1.5 months. Are we likely to see another spike in oil prices? One doesn't know, because oil prices, unlike many other commodity prices, are driven not just by the demand supply equation, but also by various geopolitical decisions. But if we do have to contend with the recession narrative in the developed markets, then it looks like oil prices would stay pretty much where they are. Even the major suppliers like OPEC haven't are not really trying to curtail supplies in a big way at this point of time. So I'm actually, it's difficult to predict, but I'm actually reasonably positive on the fuel prices staying where they are, and therefore the Indian currency stabilizing at the current levels. The only other factor that could bring down India are valuations, where the good quality stocks are, like as always, trading at huge valuation premiums, which could engender some kind of investment fatigue on the part of FIIs and domestic investors.
Manishi, what about the overall recessionary slowdown scenario? I mean, there's this last 1 month has seen this whole argument of India decoupling coming to the fore, which almost invariably never happens, right? We join at the hip. My question is, but there are people making arguments that hey, because there's a lack of other options, India is the only destination, which may well be true for now. When it changes, right? And if the world indeed goes into a recessionary scenario, should it not bring down Indian valuations too, even if India were an island of high growth in an otherwise really low growth or a recessionary world?
Oh, absolutely. If the world really does go into a recession, and suppose it turns out not a shallow recession, but a slightly deeper version of that, I think all risk assets, including emerging markets, including India, would suffer. There's no doubt about that. And the best example in this regard is the global financial crisis. Even during that period, India's relative valuations stayed high for almost a 16-month period, from late 2006 to around mid 2008. But On an absolute basis, the market did decline. Maybe it outperformed relative to Asia, but absolute valuations, absolute share prices, I don't think they would be protected, even in India, if we do have a recession in the developed markets.
But that's not your base case.
That's not our base case. I mean, we are sort of cognizant of a recessionary risk in the European region, not so much in the United States, um, primarily because of the jobs situation over there. The employment situation still remains robust, and we think that what the Fed is doing in terms of rate hikes, it would obviously lead to a slowdown, and that's what they want to engineer. But would it lead to a recession? I mean, we are sort of reserving our opinion on that.
Got it. Okay. Within India, Manishi, what's your sense? You mentioned, I mean, valuations are there is no re-rating possibility, if you will. So therefore, it has to be a churn within themes which will either show earnings growth or have valuation comfort, I would reckon. Where
Right.
are you betting on?
The first point is earnings growth. And here, financials, particularly banks, is where we are positive on, because if you look at the most obvious driver of such earnings growth, it's the non-food credit growth, which is now at about 15%. Even 1 year ago, it was hardly at about 6 to 7%. On top of that, when interest rates tend to go up, you in most cases you tend to have net interest margin expansion. In India, it might be a rate calculation, but higher, the financial sector higher. So that's our core overweight position in our India allocation. Financials, particularly private banks, with a smattering of public sector banks as well. The second important sector are automobiles, where we're seeing improvement in discretionary consumption, and therefore the market leaders in each of the segments are likely to do better. Third, I mean, even though I talked about the IT services earnings estimates coming down, we have exposure to the top tier IT service companies, because um, the earnings or the order flows into these companies are still strong. Maybe they are having to fork out more for outsourcing of the work to yeah, to individuals who are not part of the company as well, but it's something that we must keep a watch on. So both new order flows and the currency, both are tailwinds for the IT service sector. So these are the three main buckets in India that we like. We also have select few consumer staples companies, because the decline in soft commodities is likely to drive their margins higher. So that is, in a nutshell, our positioning within India. And we have an overweight on India, which we are retaining for now in our Asian model portfolio.
Got it. Okay, you already told us what will change that. Let me stick to themes then. What about global energy, Manishi? You have a really strong handle on this while you look at the Asian Pacific region at large. But I am tempted to ask you about something that you used to do at a micro level many years back. What's your
That's
sense
right.
on global energy and India energy?
Right. So, in case of global energy, or in our Asia Pac asset allocation, we still have a positive stance there. It's the combination of both E&P and the refiners. In case of India, it's a slightly different story, because
Mhm.
here regulatory aspects have tended to influence margins of the Indian refining and marketing companies in a slightly divergent way than they have influenced the rest of Asia. So, in case of India, while we do have exposure to the conglomerates in this area, we don't really have any of the pure play refiners or explorers.
Okay. Okay. Now, I would reckon it takes something for publications like Economist to write glowing terms about Indian growth, Manishi. But that has happened. There's a lot of talk about newer sectors that India is embarking upon, PLI-led schemes, defense. A lot of it is also B2G. So while B2G is usually not considered to be a great term because of cash
Mm,
flows and receivables, is B2G and beneficiaries out there also forming a part of your recommendation list, or are you kind of staying away from there?
See, at the present point, no, not because of any thematic aversion to those, but many of those talks we don't cover on a bottom-up basis. That's possibly the more, the bigger reason at this point. BTG actually could be an interesting driver, and in the sectors that you talked about, particularly defense. Having said this, if I look at a broad upturn in the economy, it's really private sector spending, private sector capex that'll have to come back. We haven't yet seen that in a big way. As of now, the spending that we're seeing is largely from the government in infrastructure, in defense, and so on. But for a bigger and more broad-based recovery to come in, we are still waiting for private sector capex. We believe it's around the corner. Maybe not immediately, but at some point of time next year. But that would really be the bigger driver.
Okay, but you've not been tempted to look at themes like defense, which has suddenly caught the eye of everybody's imagination, for example.
We haven't yet, looked at those sectors in much detail,
Okay.
and I mean,
Got it.
thematically they do look good, but not we haven't looked at them on a stock specific basis.
I get your point. Okay, my final question then, and therefore I'm moving away from B2G to cycles, and there's a lot of talk about in India at least. Actually, let me try and rephrase my question. World over, real estate prices have started to buckle down. We've seen that happening maybe in the US as well, but certainly Australia, Canada, Japan.
Right.
India prices are still okay, but Indian prices haven't really moved too northwards in the last few years as well. And everybody talks about a big real estate cycle underway in India. How have you looked at it? Do you believe this is multi-year, or do you believe it's time to be cautious?
You see, real estate in India, if you look at average property prices or property construction, they had almost a 10-year lull period. Property prices actually not only stayed stagnant, they actually tanked in some of the bigger cities. So I think, the concern on property prices essentially arises from the uptick in interest rates, in the developed markets and also in parts of Asia. In India, we're seeing two differences. First, as I said, that it's starting from a very low base, this uptick in property prices. And second, the interest rate increases have not been so egregious as we have seen in the developed markets, for the obvious reason that inflation has not been so much of a concern in the Asian region. So yes, I mean, we do like the property space. We think apart from the developers, even the property sector lenders, the mortgage lenders, they could be an interesting and innovative way to play that sector.
Got it. Okay. Manishi, this was as informative as it can get. Thank you so much for taking the time out on such an important week and talking to us. And look forward to meeting you when you do your India trip.
Absolutely. Same here. Thank you very much.
Thank you for giving us your time. Viewers, thanks for tuning into this edition of The Talking Point.